All right, let's talk about Oscar Health. It's a really wild story from the health tech world. One minute, it was the darling of Wall Street, and the next, its stock was in a total free fall. It's a real puzzle, and in this explainer, we're going to piece it together.
So let's just put a number on it. In just a handful of weeks, Oscar Health stock absolutely plummeted. We're talking a 40% drop from its recent high. A huge chunk of its value just gone. It left a lot of investors completely stunned, asking themselves, what in the world just happened?
And this quote from a user on Reddit really captures that feeling of whiplash perfectly. You know, the confusion, the frustration. One second there's all this incredible hype, and the next, poof, it's all gone. This feeling was pretty much everywhere on trading forums.
Which brings us right to the main question. What's actually going on here? Is this company broken, or is this some kind of massive opportunity in disguise? Now, to figure that out, we can't just ride the waves of hype. We need a proper framework, the same kind of process a professional analyst would use to investigate. And that framework is called due diligence. So we're going to use Oscar Health as a case study to walk through exactly how it works, looking at the good, the bad, and the whole big picture.
So what is due diligence, really? Well, to put it simply, it's just doing your homework. It means you're digging past all the flashy headlines to confirm the actual facts, to understand what the real risks are, and to spot where the opportunities might be hiding. It's about getting the full story, not just the exciting part.
We're going to break our investigation down into 3 simple steps. First, we'll look at the bull case. You know, why were investors so fired up about this company? Then, we'll hit the bear case. What were the headwinds that made the stock totally tank? And finally, we'll put it all together and try to weigh the risk versus the reward.
So let's start with the bull case. Why did so many people believe that Oscar was on the verge of completely revolutionizing the entire healthcare industry? What was the big idea? The whole argument for Oscar, the reason everyone got so excited, really boils down to this. Oscar claims it isn't just another insurance company. It's a tech company. They have this thing called the Oscar platform, which uses AI and automation to make healthcare way more efficient. Think AI care guides that handle tasks and get back to members faster, or virtual care that seriously cuts down on costs. And there was proof it was working. Their SG&A ratio, which is just a fancy way of measuring operating costs, hit a record low. That suggested their tech-first model was the real deal.
And you know what? That tech-first approach was bringing in customers. A lot of them. In a single year, Oscar's membership exploded by 41% to over 2 million people. That's not just good growth, that's explosive growth, especially in such a tough, competitive industry. And a huge part of that growth was this really smart strategy. They went after underserved communities. For example, their Buena Salud initiative, which was designed for Hispanic members, earned a Net Promoter Score of 87. Now, to put that in perspective, anything over 70 is considered world-class. So 87 for an insurance company? That is almost unheard of. It showed they had a powerful strategy that could really scale.
Okay, so that's the exciting story of innovation and growth. It's a great story, but it's only half the picture. Now we've got to look at the bear case, the story that explains that massive 40% stock drop.
And here's where the whiplash really kicks in. To understand just how big the shock was, you have to know that only last quarter, Oscar was absolutely flying. They reported a record net income of $275 million. Everything, and I mean everything, seemed to be pointing straight up.
And then, this happened. The company completely flipped its forecast for the entire year. They went from projecting a profit of over $225 million to a loss of over $200 million. That's a nearly $500 million swing, and it was pretty much all triggered by one thing: costs in the Affordable Care Act marketplace that were way, way higher than they expected.
As you can imagine, Wall Street reacted fast and hard. You can see it right here. The analyst ratings shifted like night and day, going from a healthy mix of buys and holds to almost all sells. And when the experts get that spooked that quickly, the market listens.
It's also really important to note, this wasn't all happening in a bubble. The entire healthcare sector has been struggling. You can see that while the broader market was surging, healthcare stocks were just lagging way behind. So industry-wide problems like inflation and uncertainty around policy were hitting everybody, not just Oscar. So we're left with two completely opposite stories, right? On one hand, you've got this tech-driven innovator with incredible growth, and on the other, a company facing these massive, unexpected financial problems. So how do we make sense of this? How do we weigh these two things?
Well, this brings us right to the core conflict. It's a bet on what Oscar is at its heart. The bulls, they see a founder-led company that's valued like a tech disruptor, and they're betting that its technology will ultimately win out and reshape healthcare. The bears, though, they argue that no matter how slick the app is, Oscar's still an insurance company. It's facing the same old-school industry risks, but it's got this shiny new-school tech stock price tag.
And that leaves us with the ultimate question, doesn't it? Is Oscar a true tech pioneer that's just hitting a rough patch on its way to disrupting a trillion-dollar industry? Or is it just a health insurer dressed up in tech clothing, now facing the tough, messy reality of its business? Answering that question is really the key to solving the whole Oscar Health puzzle.